Welcome back to the Keiser Report. Oh boy, this is going to be a treat. Time now to go to Westport, Connecticut, talk with Peter Schiff, CEO of Euro Pacific Capital, author of Crash Proof, and How an Economy Grows and Why It Crashes. Peter Schiff, welcome back to the Keiser Report.
Well, thanks for having me on again, Max.
All right, you were extremely accurate in your forecast for housing prices in your book Crash Proof. Talked about Fannie Mae and Freddie Mac collapsing. All that turned out to be true. We're at a point in the cycle for housing now. People are questioning, have we hit a bottom in housing? I saw something on Business Insider today alluding to that, but there is some dissenting views on housing. Housing, of course, is a key part of this crisis today and going forward. What are your thoughts on housing, Peter Schiff?
Well, I still think that the prices are being artificially propped up by government supports in the form of very low interest rates from the Fed and guarantees from the government, both Fannie and Freddie and the FHA. So real estate prices are higher than they would be in a free market. But ultimately, I think supply and demand will bring prices down despite the government's efforts to prop them up. And I think you're going to have to see a continuing decline. You've got a lot of property that ultimately is going to come on the market. You have a lot of foreclosures in the pipeline. You've got a lot of people that are living in homes for a year, 2 years, haven't even paid any mortgages, and they haven't even started the foreclosure process.
All right, so you've got housing is still in terrible shape. As we all know, the crisis in 2008 precipitated by a lot of bad loans that were made, faulty securitization, faulty marketing of securitized portfolios, the collateralized debt obligations, etc. Now, the banks today are saying our balance sheets are in pretty good health. However, if what you're saying about housing is accurate, then, we know that a lot of the loans that they're carrying on their books, they value at 100 cents on the dollar. There haven't been any serious mark-to-market of those loans. The banks' balance sheets, are they as healthy as the banks are alluding to?
Well, no, they're only healthy as long as interest rates stay at these artificially low levels. And that's one of the reasons that the Federal Reserve is keeping them there. You know, rather than raising rates like it should be doing, it's afraid to do that because it'll expose the insolvency at the banks. So in order to keep rates low, Bernanke has to lie and pretend there's no inflation because if he acknowledges what's obvious, then he has to raise rates, but he can't do that without tanking the U.S. economy. But of course, we need to let this phony economy collapse because until we do, we're never going to be able to build a sustainable economy to replace it. And the longer we try to maintain this bubble, the worse the underlying fundamentals get and the more painful it will be ultimately to correct them.
The question is, I guess, on everyone's mind relating to the dollar, very similar today to what we saw in 2008. 2008, you had a counter-trend rally in the dollar or a dead cat bounce or what you refer to as a false rally in the dollar. As we're heading into this 2011 similar crunch, an echo of 2008, the dollar can't even muster a dead cat bounce. Is that an indication of how screwed up the dollar is?
Yeah, I think that rally in '08 was the massive head fake, and I described it as a head fake back then. And a lot of people started running in the direction of the dollar. And I think the people who piled into the dollar in late '08, early '09 have lost a lot of money. And I don't expect that rally to repeat. I think the real move is down in the dollar, specifically because of what the government did in response to the financial crisis of 2008. One of the reasons the dollar rallied was because back then there was still an unknown. We didn't know if the Fed was going to try to prop everything up. There was a chance that they would let all these banks fail and the dollar would have rallied in that environment. But that's not what happened. And the Fed has shown its hand, and it's of all inflation. They're going to print. They're not going to let the banks fail. They're not going to let real estate implode. They're going to keep printing money. They're not going to force Congress to cut spending. They're going to monetize whatever Congress wants to spend. And under that environment, the dollar can only go down. And as I said, I think it has a big drop coming. And ultimately, I think the dollar will fall so much that the Fed will be forced to ultimately do the right thing or risk a complete collapse in the dollar, hyperinflation, where the dollar basically ceases to function as a viable medium of exchange. And the only way to avoid that is going to be to administer the medicine that we should have administered years ago.
I noticed your brother in there in the money management space For example, you've got Bill Gross over there at PIMCO. Mark Faber, famously also joining this chorus of those who are selling U.S. government treasury bonds and even shorting U.S. government treasury bonds. You have also pointed to this trade as something to look at. What about that idea? Because not only is it about, let's say, positioning a portfolio to avoid the risk of owning this U.S. government bond, but these folks, and possibly yourself, becoming a lot more aggressive, because when you're shorting those bonds, you're taking quite an action that, as we know with the money flows around the world, can actually help precipitate the outcome, if you know what I mean. What are your thoughts there?
Well, the only problem with shorting the bonds is that the government can print money and keep buying them, and that will ultimately prevent bond prices from falling. But if they do that, then the dollar collapses. And so you're probably better off, if you're bearish on treasuries, you're probably a safer trade is just to short the dollar, because if the Fed tries to keep treasuries from falling by buying them, it has to do it by printing money and debasing the dollar. So probably the dollar short is a safer bet than a pure treasury short, because the Fed can intervene for a while and keep treasuries from falling. But if they do that, you might want to look at other bonds too, because if they're just buying treasuries and they keep printing money, that's going to hurt corporate bonds. That's going to hurt municipal bonds. All U.S. dollar-denominated bonds will start falling in price unless the Fed buys those too. But then if the Fed tries to buy other bonds to keep all rates low, then it has to print even more money, which is even more negative for the dollar. So shorting the dollar or buying silver or buying gold or buying commodities might be a more effective way of shorting bonds.
Okay, now I want to change gears here for a second and talk about oil. And interesting, Barack Obama has come out and said recently that he's instructed the Justice Department to look into oil market manipulation in response to the recent price spike in oil. Now, given what we've been talking about, massive money printing, talk a little bit about this, please, Peter Schiff.
Yeah, well, I mean, the whole thing is a farce to ignore the real cause, and that is the Federal Reserve. Barack Obama should be sending his investigators over there. And in fact, Barack Obama is a co-conspirator, co-culprit, because the reason that the Federal Reserve is printing so much money is because Barack Obama and Congress are spending so much money. They're not collecting enough in taxes. And so Ben Bernanke is printing up the difference. And the result is rising prices. So, you can think of higher gas prices as simply a tax, because the government didn't raise taxes. They didn't raise income taxes or payroll taxes. They decided to run a deficit and have the Fed monetize it. The way we pay for it is higher prices, because instead of taking our money, the government is taking our purchasing power. And the result is that gas prices go up, food prices go up. So all these prices are rising because Barack Obama is spending so much money and running these huge deficits. So rather than commissioning a study, he should just look in the mirror and find the cause. And if he really feels the pain of the average American, as he pretends he does, because of the pump, he'd cut government spending. He'd shut off the spigots right now. But this is how we're paying for government. We're paying for it with $4 gasoline. But pretty soon it'll be $5, $6, $10. There is no end in sight. As long as the government keeps spending and the Fed keeps printing to finance it, prices for everything is going to go up.
All right, let's talk about China for a second, because the RMB, you predicted that they would raise the value of the RMB to something that the U.S. has been encouraging, but actually it's not good, because this shifts purchasing power to China and actually is a negative for the dollar. Can you talk a little bit about that?
Yeah, the Chinese have undervalued their currency for years, and we constantly accuse China that somehow doing that benefits China at our expense, when it's actually the reverse. Because what happens is the Chinese undermine their own purchasing power, so their own citizens see the value of their savings and the value of their wages diminished, and so they can't afford to buy a lot of things that, absent that intervention, they would be able to afford. And the flip side of that is Americans are able to buy things that, absent that intervention, we couldn't afford. And so our shelves are full of products made in China, yet the Chinese shelves don't have those products, or if they have them, they're too expensive for many Chinese to buy. But if the Chinese government were simply to remove those impediments and allow the RMB to rise, then everything would go on sale for the Chinese. Everything would get cheaper. And everything would get more expensive for Americans. And not only would prices rise, but interest rates would rise, because in order to suppress the value of the RMB, they buy a lot of dollars, and they use those dollars to buy U.S. treasuries, and that creates more demand for treasuries, and that helps keep the rates down. And it's not just China. It's with China keeping its currency down, you have all these other countries in Southeast Asia that are trying to remain competitive with China, and so they're buying dollars. And that's why you see all these sovereign wealth funds all around the world that are loaded up with dollars, because all these countries are trying to keep their currency low, but we gain, they lose. And when they realize that this is not in their interest, they will stop doing it, because these are political decisions to buy dollars and suppress their currencies. And when they start to believe that these decisions are wrong, and they start to see the consequence right now is inflation. All these countries that are suppressing their currency have to print a lot of money to do it. That's inflation. And prices are rising, and people in a lot of these countries are hurt harder by higher food and energy prices, because it represents a bigger chunk of their expenditures. And so as countries like China start to appreciate how big the cost is of propping up the dollar, and they'll realize that letting the dollar collapse is a much better way to go, even if it does result in some losses in their foreign reserves, and it does result in fewer sales to America. Net, it's a big gain for China and the Chinese people, and all the other countries that allow their currencies to rise.
Right. So this, the vaunted symbiotic relationship between U.S. and China is one that China is willing to break, because they end up.
It's symbiotic in the sense that slavery was symbiotic. If you think that a slave and the master are symbiotic, because the slave gets to work and the master gets to enjoy the fruits of his labor, that doesn't seem too symbiotic. That seems parasitic to me. And I think that's what's been going on with China. They work really hard and they don't have anything to show for it. We get to consume what they produce, and they're just working to help to prop our economy up, to provide us with goods that we can't afford. That is not a good deal for the Chinese.
All right, last question. You've been a big supporter of Ron Paul. Of course, you ran for Senate in Connecticut during the last election cycle. Ron Paul, I believe he's announced he's going to run for 2012. He's got a lot of support. It's growing support. If he makes it to the White House, would there be a role in his administration for Peter Schiff?
Well, I guess it's a bit presumptuous. I mean, I was with Ron Paul last night. We spoke at an event in New York City. It was very well attended. A lot of young people were there. I mean, first let's see if Ron can get elected. I certainly will do everything I can to help him in that effort. And if he were to get elected, and if he were to invite me to Washington, I'd probably come. But there's a lot of ifs in there. So first, let's see if he can get the Republican nomination, which is no small task.
Well, Peter Schiff, that's all time for we have this week. But thanks so much again for being on the Keiser Report.
Sure, Max.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Peter Schiff, president of Euro Pacific Capital. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.